past month, as we've been telling you, the profit reporting season, February, the ASX 200, I can show you, is ahead by 1.2%. So it's been okay, but not really stellar. And that suggests to you that the earnings from Australian companies haven't really been all that bad. Well, today is the last day in February, so the last day that the profits report keep on coming. Ed Boyd is with me, as he has been throughout the month, checking on the reactions to those earnings reports. So, Ed, generally, as we get to this last day, how have you seen it all wrap out?
Ross, it's actually been a pretty good profit reporting season. I think going into the February reporting season, we were really worried about the strength of the Australian consumer, how Aussie consumer spending was going to hold up, and it actually held up really well. We saw the retailers perform pretty strongly, but the sector that's really stood out, and you can see on the screen here, is the tech sector. There's been a lot of investment going into the tech sector, a lot of growth opportunities. Just look at Appen. Admittedly, Appen, Ross, is coming off a low base, but it is up 76% in the past month. Kogan, online retailer, started paying dividends again, up 37%. Lithium, there's a takeover going on there with a Japanese business, so they were strong. And WiseTech, shares are now at a record high. But companies that haven't done so well, if we move on to the next slide, we can look at the bottom performers for the past 30 days. Travel sector is recovering. Corporate travel's had a few issues. The mining sector overall has been struggling with falling commodity prices. You can see that with Resolute there and Whitehaven Coal. And then Ingham's has really struggled with rising costs and inflation. And that's been the key kicker for them.
So that's been the key, hasn't it? Inflation really is the whole thing about the costs, controlling it, and whether they can raise prices. That's been one of the keys. Thanks so much, Ed. We'll be back to Ed very shortly with some reaction for some of the companies that reported today. Harvey Norman, one of those. It says inflation continues to dampen discretionary retail spending in Australia, as it reported an almost 30% fall in pre-tax profit to $303 million. Though revenue is blurred because Harvey Norman gained some money from company-owned stores and other revenue from franchisee rents, it still fell 14% to $511 million. Interim dividend here cut 3 cents to 10 cents a share. Well, earlier today, I spoke with Harvey Norman's chairman, Gerry Harvey, who thinks there is a cost of living crisis, but he also thinks the government supermarket price inquiry is a smokescreen.
When it comes out the supermarket makes 3 cents in the dollar, you say, how can it lower its price? I mean, what are you going on about? Look, the fact is it makes 3 cents in the dollar. Do you want it to make 1 cent or no cent?
Could Harvey Norman survive on 3 cents in the dollar?
Yeah, sure.
You could?
Yeah, of course we can, but you survive a lot better on 4 or 5 cents in the dollar, and you don't survive on no cents in the dollar. So we all work on a very low margin.
You don't survive on no cents in the dollar, Gerry Harvey there. So how did Harvey Norman shares go today?
Pretty well, Ross. Harvey Norman was one of the best performers on the market. The shares took off. Investors thought the result was going to be a lot worse. I think they're also pleased with the outlook statement. It says the company's in good shape and really ready to sell products as soon as the property market picks up again. It's also on track to open a flagship store in the UK later this year. So Harvey Norman up 4.4%.
OK, the next one we go to is the strife-torn casino operator, The Star. It's in a world of pain. Just last week, the New South Wales Casino Commission ordered another investigation into the group to determine if it's fit to hold a licence in that state to operate. Well, today the company says higher levels of risk and compliance resourcing, higher remediation costs, increased competition and weaker discretionary spending. Is there anything else they could have added in there? They've all smashed its profit. Revenue down 14%, $865 million. Net profit before significant items down 42% to just $25 million. But its statutory profit after write-downs, $9.1 million. That compares with last year when it wrote off almost $1.25 billion as it wrote down the value of its businesses. The company reports it now has 197 full-time staff in risk, compliance and safer gambling, compared with just 44 in September 21 before the you-know-what hit the fan. Well, Ed, the stock for The Star, it's been in trouble, hasn't it?
It's been in a lot of trouble. Today, it did do pretty well, actually. It has been crunched recently, but it did say today they managed to raise $750 million in capital from investors during the half. They refinanced about $450 million in debt. So The Star's positive about the future, despite this new inquiry in New South Wales. So it was one of the top performers again, up 8.3%.
Nothing hitting the fan there today, at least anyway. Ramsay Healthcare is one of the world's largest private hospital and healthcare groups. Well, today it said underlying half-year profit fell 23% to $140 million, affected by high inflation in the healthcare sector. Total revenue gained 13.8%, around $8.1 billion. The company reinstated its dividend at 40 cents in the dollar. Last year, Ramsay's profit was skewed by the sale of its Asian operation, Ramsay Sime Darby, which netted an after-tax profit of around $618 million for it. The company reported that long-term it'll continue to grow, most likely at high single-digit figures. But it does say that higher costs have squeezed margins and the recovery will be slow because the pressures simply are not disappearing quickly. So, Ramsay Healthcare shares?
You'd think they'd fall, but actually they did pretty well. They had one of their best days on the market in a couple of years, lifting strongly despite what looked like a pretty tough profit result. Investors clearly expecting worse. Management are expecting to post a profit this year, so I think there was a lot of positivity there, up 7.3%. Turning to the overall market, the ASX 200 opened higher this morning, lifted by property REITs, retailers and healthcare stocks. Only one sector was in the red, that was utilities. Market finished the day up 0.5%, and it's almost back to its record high. Payments company EML, it lifted after getting crunched yesterday when it reported a $12 million loss in the half. Synthetic skin company Polynovo jumped after its results yesterday as well. And Goodman Group was the top property stock, up about just under 4%. Sleep apnea treatment business Resmed slipped. There was no announcement from them today. Lithium miner IGO slumped as well due to the weak commodity prices. And fund manager Perpetual dropped again after being one of the worst performers yesterday. And Ross, that's market.